Hello and good evening, everybody out there in YouTube land. Welcome to this live YouTube webinar here with Tackle Trading. We're going to be talking about quite a few interesting things today. As I'm just kind of waiting for my YouTube live feed to come up, kind of let me know that I'm live here and waiting for folks to trickle in. We're going to be talking about the power of leverage, and we're going to be talking about call options. And we're going to go through and define a lot of we're just going to explore what the definitions are, make sure people understand how the contracts for call options work. And we're going to talk about some of the rules. We're going to talk about the practical applications of long calls and really just learning how to understand and tap into the power of that leverage. I mean, the leverage of call options is really a beautiful thing. And to help me discuss all this stuff tonight, I am joined by the one, the only, my fourth favorite Canadian, Coach Old Money Greg Holmes. How you doing, Greg? You there?
Very good. You mean I gained 10 spots since yesterday?
That's for awesome. Sure. You're up. You're definitely up. The only people you fall behind are the power trio.
Wayne Gretzky,
Wayne Gretzky,
John Candy, and Justin Trudeau, right?
Justin Timberlake? No, he's Timberlake. Not Canadian. I was thinking of Justin Bieber. My bad.
Bieber, no, yeah, he's out too.
So. Make me believe. I was, of course, referring to the greatest rock band of all time.
So, Rush, yes, yeah, okay.
They're not bad. They're pretty cool Canadians. But so I'm still waiting to see if my YouTube, there it is. I see it live now. We got folks trickling in, and I always like to see who's here. We get a good feel for it. So if you're out there and you're logged in, hey, chime in and say hello. Let me know that you're out there. And I'm sure we have a lot of our tackle, trading tried and true pro members and veterans. This particular webinar here tonight, we're going to be kind of gearing it towards beginners, particularly at first, where we just break down some basic, definitions and explain, what a call option is. We talk about why we would want to use them. And then we're going to get in and talk about when it would be appropriate to use them. And then how do we actually get in and trade options safely and to really, take advantage of that leverage. So, hey, James, glad to have you here. I like the crash test dummies too. I'd throw the bare naked ladies in there up on the top list. And there's so many great Canadians. I love them. They're the best. So glad to have Greg here with us. And we're going to start out just by walking through some definitions and just introducing the basics for the benefit of the new members of Tackle Trading and for some of the people out there who are just interested in learning. So if you're an experienced veteran out there like Tri, glad to have you here. We're going to be talking about stuff that's going to be a basic review for you at first. Then we're going to get into that practical application. And we're going to get in and talk about some of the nuances that can go into trading with call options. And I've got a couple of decent candidates lined up for you where we can talk about what are the best ways to go about using that, call option leverage. So if you're out there and you're listening, and again, I see more and more people trickling in, if you're in the chat, if you are a pro member, type in pro member. If you're new to us, introduce yourself, say hello, or I'm new. And again, just glad to have people here. So now, Greg, you've been trading for a while now. Yep. How long you been trading?
I've got over a decade, I guess.
Okay. And as you learned the ropes and you worked on building your financial literacy, how long did it take you to go from the idea of just investing in things like stocks or mutual funds or stuff that most people have heard of to getting into options, into the world of options?
Yeah, well, for me, it took a while because I was in the financial world first as a financial advisor. And so I was deep down the rabbit hole of your mutual funds and your financial planning and all that kind of stuff. And it was after some pain in the markets and the fact that I realized that I was unable to help my clients with the status quo of products that were available. So that's when I started reading a little more, started, getting more into, different investing. And then I started looking at the options side of things, and I was lucky enough to get a mentor who started to show me some things. And I would say it was a few years anyway, maybe even I want to say maybe 5 or 6 before I actually got into the options. But that wasn't part of my decade of trading either. That was kind of pre-trading. But it was a while before I got into options. But what I realized from options is that it's great to be able to use it to make money, but it's even more importantly used to save money, to protect things. And that was really originally my first foray. Was I was just trying to save people, save their portfolios, because the reality is you get in certain products and there's no safety net. When Mr. Market turns ugly, you get to ride it all the way down, or you get to get out, which can be just as painful sometimes. So.
Well, absolutely. And I think that's very interesting. And I myself, I'd say, kind of had a similar experience where the first thing I thought about was learning how to invest in stocks. Then I got into the idea of trading stocks short term for income. And I was really intimidated by the world of options up front. It seemed like a layer of complexity that's just kind of scared me off a little bit. And quite frankly, I think one of the reasons I really put off learning options is because I looked at an options chain very early on, and there was so many numbers and choices there that I had no idea what that any of it meant. And so I got a little bit intimidated by just the sheer number of choices that options present. And I just found the number and availability of strike prices and expiration dates, it just seemed overwhelming and confusing. But after I spent a little bit of time learning the basic concepts, it finally occurred to me that options are really relatively simple at the end of the day. But getting to that point of simplicity, I think, takes new traders and investors a while to get into. And then on the flip side of that coin, options provide leverage, which is very, very seductive. And the idea of putting a little bit of money in and being able to get a really high rate of return out of a speculative play or an investment with an option, I think is really attractive to people. And it can be so seductive. I think it oftentimes even can be a bit of a detriment to people's, mindset on trading and investing, and that desire I think we all have, to get rich quick it's very, very seductive. And so I want to be guarded against that and make sure we're teaching good best practices and just talking about the realities of options. But I'm here on the Tackle Trading homepage, and I'm going to use some of the features of the Tackle Trading website and services as we go through the discussion. And you'll notice right there on the main page, it talks about stocks, options, commodities, and Forex. And I think it's really interesting, Greg. There's a lot of new blood in this market, new traders and investors out there. With the advent of, smartphone technology, the proliferation of Wi-Fi everywhere, and just access to the technology, plus the lowering the bar to entry by a lot of the brokerages out there, particularly some of the new brokerages that have really gained in popularity, like the Robinhoods, where they offer, commission-free trading. And I think that's got a lot of people out there interested in learning how to trade and invest. And some people are getting so excited, they're putting their enthusiasm and excitement to invest before their education. And I think we've all, seen a few horror stories or two out of the new fresh. We'll call it new money, since we have old money homes here. We're going to call about the new money in the market. And I think that they could really benefit from just putting some time and effort and energy into educating themselves. And there's a lot of benefits to trading options. Like, you can lower the amount of capital requirement it takes for you to control or speculate on a stock. It gives you choices on how you can, go about your trading and investing. And then one of the things you mentioned, Greg, is one of the nicest things about options is we can use them to control and limit risk. And it gives us a lot of choices in how we do that. So we're going to get in and talk about that. And I'm going to use a couple of the features here. I'm going to spend some time inside the tackle trading playbook, as we talk about, what a call is, I break down some of the definitions for you. And as we progress through this conversation, hopefully by the end, you'll walk away with some really great trading and investing ideas, and just hopefully a better clarity and understanding of what options are, how we can use them. And we can, take everything we learn about call options, and you can apply the same lessons to put options. And at the end of the day, I'm going to make everybody an invitation. We obviously have a lot of pro members here, but we're obviously, promoting tackle trading. We're promoting our products and services, and just educational platform and community. And I love our community. We've got, so many of them here already. I'm recognizing the names, like, hey, we got another Canadian here in Gino. We got Linda. We already have Tri. We already mentioned him. We got Michael Dime. It's so nice to see y'all here. Hey, Dennis, how you doing? Frank, even the breakout Frank showed up. I wouldn't be opposed to Frank jumping into the conversation at any point in time. And I bet you Frank has good candidates for us to talk about. So if you have any good setups, Frank, you just go ahead and throw them there in the chat when we get to that point. That'd be very helpful. So I'm going to start out by jumping into the tackle trading playbook. Now, to get to the playbook, you go up to the trade center and you go into the tackle trading playbook. Now, I already have that page open. And so this is what you land on when you click on the tackle trading playbook. And the tackle trading playbook has got a lot of strategies. We have directional strategies, which we refer to as delta strategies. Hey, Ahmed, how you doing? Don't want to leave you out. We got theta strategies. We got vega strategies. And our directional trading playbook is where it starts out. Hey, this is where you identify a stock you think is going to go up or down, and you can speculate on that directional price movement. I believe the trend is going to continue. I think that XYZ stock looks great. I think they got a lot of upside potential, and you can speculate on the value of that stock price going up. And in that directional playbook where we can show you how to go about that, we've got quite a few strategies to choose from. And we have what here? We got 4 across and 4 deep. So that's 16 directional strategies. And some of them are real simple, like long stock, buying a stock position, short stock, selling a stock position short. We have long call, we have long put. And we're going to start out here clicking on the long call. Now, the playbook's really, really awesome for those of you who know how to use it and gain access to. This is something that all Tackle Trading Pro members have access to. You can click on the section here, and actually you can click on play. It'll pop open a video, and it'll open up a video, and you've got a nice little 12-minute lesson on what a long call is. In fact, I should probably just play that, go get a drink, come back, and then we can just pick it up in a few minutes.
Go for a soda.
Go for a soda, yeah. But it gives you, again, a nice definition. It breaks down, some of the philosophies behind it, and you just got really good, introduction and commentary, an example of how you would go about using it. And it's just a really good, simple introduction to what a long call is. But we also give you some of the rules for trading and investing with those options, how to go about it, what are the things you should be doing and avoiding, and just designed to kind of keep you safe and really help you approach the markets with education, knowledge, and intelligence. And really phenomenal resource. So if you love the playbook, or you use the playbook, and again, you've experienced the awesomeness that is the playbook, I'd like to see you in the chat, give us a little feedback on the playbook. Tell us what you think about it. You can also, of course, click on the PDF to download it, and that goes along with, and it gives you everything you have in the little presentation. So I'm going to go through the playbook PDF right here and just talk about what a long call is, and then we'll break down that, I'll give you a couple of examples to help you understand it. Again, for those tried and true pro members, hang on, we're going to get there. We're going to get there from here where we get to some of the exciting stuff at the end. So a long call, again, together with the long put option, is one of the most basic and common option strategies out there. A trader is said to be long a call option when they have purchased one or more call options. Now, what is a call option? A call option is a contract. An option is a contract between a buyer and a seller that gives the buyer of the option the right to do something without an obligation. So in the case of a call option, the buyer of the call option has the right to buy the underlying asset of a stock, for example, at a predetermined price on or before a predetermined date. and they have no obligation. But if the option works out where they could exercise that right and it's in their interest to do so, they basically purchase and pay for a contract that gives them the right to buy the underlying security. And the people who sell those contracts, they get compensated. They get paid for the contract. They get paid for making a promise. And then they have an obligation, but they are the ones who receive the premium. So if I were to kind of illustrate it out, and I use this often just kind of as a basic example, we're going to illustrate this out. We're going to say, that this is Greg, and Greg is, nice, tall, handsome Canadian. And then I'm a little bit shorter. I'm over here. We'll say this is me. I'm a little shorter, not as good looking, possibly not as smart, but so this is Greg. And then this over here is Noah. Okay. Now let's take I don't know, Greg, throw out a stock out there that you like, just not a recommendation or anything, but just a stock, your company you like.
Actually, I've been watching Agilent recently.
Agilent Technologies, Agilent Technologies.
Agilent, yeah.
Okay. What's their ticker symbol?
A, actually, just A.
Agilent. So ticker symbol
and,
A.
And that's the A as
not
in the
to
letter,
be confused
not
with A, as in like I'm a Canadian A, but an actual A. So ticker symbol A. Well, we could imagine for a moment that Greg, he owns Agilent. So if Greg owns Agilent Technology, he owns those shares. That's an asset that he owns, and he could promise to sell me that stock at a higher price. What's Agilent trading at right now? Just
$99.62, I believe, is where it closed.
$99.62. Let's actually pop that open here. I just occurred to me, I don't have my thinkorswim open. I should open that up. So I'll come back to that later, but it's trading at $99.
Yeah, $99.62, I think.
Okay, we'll call it 99 just to make that math easier. And let's say he the stock's currently trading at 99, and I don't know what price you own it at, but let's say I believe that the Agilent stock is going to go up. And I believe it's going to go up a lot. I'm very, very bullish. And you own it. Obviously, you like the company, so you're bullish on it, but you're currently a little bit more neutral. Let's say Greg thinks the stock's got a good chance to go sideways, and maybe up just a little bit, maybe down a little bit, but he likes the company for long term, and he owns it, and he's willing to, promise to sell me the right to buy Agilent at, let's say $100. So he could sell me a contract here. Say, hey, Noah, I will sell you, 100 shares. So I'll put it, 100 shares. And I promise to sell it to you at $100. That would be a price that we would agree on. So it's currently trading at 99. And Greg says, you know what, I'll sell it to you at 100. And I'm excited about that idea because I believe it's going to go up to, I believe it's going to go up to $110. I believe it's going to go up to $110. So I have a really bullish outlook. And Greg says, yeah, well, even if it goes up to $110, I don't mind selling you 100 shares now, at $100, but I'll do that in exchange for, and I'm waving cash at you. I'm like, hey, Greg, sell me your stock. I'll buy that option from you. And I'm just waving cash, making it rain. And I'm going to offer you the asking price for the contract. So we have a contract between us that would agree upon, hey, 100 shares at $100. And let's say that contract is good from now through December. So I have till, middle of December in order for that contract to work out. And that costs $5 per share. So me throwing that cash out to buy 100 shares at $5 per share, that contract would cost me $500, right? And once I give him the $500 and we have agreed to that call option contract, that kind of signs it on the dotted line. And I have a right to the stock at $100. Okay, so $100 strike price. That's the price we struck a deal at. That's the price we've agreed upon. And if the stock price goes up, even though he promised to sell it to me at $100, if he collected $5 from me, what price did he really sell it to me at? If you think about this, and I know you know the answer to this, Greg. If I paid you $5 to buy that stock from you, per share at $100 per share, what's your actual sale price? Well, you just add the premium to the strike price, right?
$105. Yeah. I'm digging it.
$105 per share. And so if it ends up going up and it ends up going up above $105 per share, Greg might be a little sad that the stock, went higher than he just sold it for. But between the contract and then the stock price and maybe some of the statistical probabilities, maybe there's only like a 40% chance that it does that. Now, if it ran up to 110 and I only gave him $5 to do that, and upon, come December, it's trading out at $110, I can exercise my right. I can take the stock from him at the $100. I could turn around and sell it at $110. But because I spent $5 to procure that right and hold on to that right, I only make $500, which is not bad. But if you stop and you think about it, if I put $500 in and I made a $500 profit, what's my ROI?
100%.
100%. That'd be pretty attractive. If I actually just bought the stock at 100 and the stock price went up to 110, I'd be up $1,000. But to buy 100 shares of the stock at, the $100 price tag, how much money would I be putting in? I'd be putting in 10 grand, right? And I'd have $1,000 return, which is more money, but my ROI is 10%, which is pretty good return, mind you. But that option return, even though it's only $500, that's a 100% return on investment. So that's an interesting concept to me. And that's one of the ideas behind the idea of the leverage. So again, a call option is just a contract between a buyer and a seller that gives the buyer the right, but no obligations, and the seller has an obligation. So, and I don't know if my numbers were realistic at all. Once I get logged in, we could actually look at that and see, what they're charging for that. Hold on one second here. Okay, just logging in my Thinkorswim. I didn't realize I didn't have that open. But that's a pretty exciting idea. Now, I don't need to have the disclaimer up. Whoops. Let's kill that stuff. All right, let's see. Did that pop open for me?
Still don't see it, no.
I don't see it either.
Do you want me to share my Thinkorswim?
Nah. Just need to log into the right account with the right password. That's usually, most of my technical difficulties come down to user error. So, okay. So, and again, I'm not overly familiar with that particular stock, but I know you're the kind of guy who sits and does his research. And so, hey, there's Agilent. It's a pretty bullish look. It's right there at $99. It poked its head up above. There's a nice resistance zone at 103. So I'm assuming I was probably high on my estimate, but if I wanted to get out, I don't have a December choice, but I got a January choice, and that $105 option, it's about $4.35.
Pretty close to $5.
Yeah. So that's now, I don't always buy out of many options, and there's a discussion we're going to have about that here in a moment. But the idea is relatively simple. If you wanted to own, and I could say, well, let's buy the right to it at $100 just to kind of compare and contrast. And at $100, that strike price, that option is going to currently cost you $6.55, which would give you the right to own the stock at $100 between now and January, in this case, the 15th of January, 2021. And if I were to go buy that option, I would have that right. Now, Greg may believe it's not going up above 100 or 105 or whatever. And if he were to sell that option, he would collect the premium right now and get paid whether the stock went up, down, or sideways. So for Greg to have the motivation and desire to sell a call option, that's probably because he A, already owns the stock, and B, is using the option to get paid to sell. And by selling the option and collecting, $6.80, or what was it? What was the price tag on it? $6.55. Getting paid $6.55. that would be the same as selling it at $106.55. And that's higher than the highest price. I mean, it's been out at 103.66. So I think that would actually be a reasonable move for somebody who owned the stock. And especially if they owned it at a lower price, like if they owned it at $80 or $90 and they were happy to sell it at 100, selling that call option and getting paid, now to promise to sell it at that price, that's not a bad deal. So there's a benefit in it for the seller. They have the obligation. So if I exercise my right, they have the obligation. And one of my favorite things about the call is, and options in general, is when you can get into a risk graph. And I love risk graphs. We're going to talk about them here in a moment. I'm going to introduce the concept and then I'm going to come back and talk about it. So let me get back to the old PowerPoint there, or not PowerPoint, but the
playbook,
the tackle playbook right there. And here we are looking at that long call. And when would I want to buy a long call? That's probably one of the first questions. I would only really want to buy a long call option if I was really bullish on the stock. I have a bias that we call it +2, +3, which means you're bullish. You think that stock price is rising. And it's a directional play. And one of the temptations, I think, with options is the leverage is so nice. You can control a lot of stock for a little bit of money. There's a greed factor. And so we've got in the playbook right here, big red light. Hey, attention. Hey, remember to do a couple things before you do this. One, make sure you understand when news and earnings dates are. Two, don't trade anything you've not practiced before. So if you're new to call options, don't go out and buy call options until you understand them. Three, your rules are and the way you approach the trade are going to vary depending on what side of your trading are. But we have some core rules at Tackle Trading as far as risk goes, like don't risk more than X amount of your account. Now, when you buy a long call, these are the general rules we would teach people to follow. Now, there's exceptions to this, and as your experience grows, some of these rules, there's some nuance to them and things that you can do. But like we have a directional delta rule, which means, hey, buy an option with the delta closest to 60. Well, what does that mean? Well, delta is a way of looking at probabilities. It's also how sensitive the option is to the movement of the underlying stock. But to have an option with a delta of 60, it's going to be in the money, and it's going to be an option that has some built-in equity. And so we're going to basically say, hey, the general rule is if you're going to buy options, buy in the money with the delta around 60. So that's a rule that you can follow. And even if you don't know what those mean yet, you learn it, you understand there's a value to the rule. It's designed to keep you buying the right kinds of things, keep you safe, et cetera, et cetera. We have a time rule. Hey, if you're going to buy an option, make sure you buy at least 2 months. If you're going to buy options, you want time on your side so that the stock price goes up. So we're going to say, hey, buy, 2 months or more. So if it's currently September, and we were talking about that Agilent, call option, buying in January, that's quite a few months from now, right? That's what, 3.5, 4 months from now, based off my count. And there's a rule there, making sure you're buying enough time, and that's important. And then there's a volatility understanding. You have to understand how volatility affects option prices. And that's an interesting concept. Again, a little bit more advanced for the newbies, but a volatility expectation would be that if the expected price move increases, or the anticipation of volatility, meaning the stock price moving up or down, increases, the options become more expensive. If that expectation for price movement goes down, it decreases, meaning they expect less movement, the options become less expensive. So generally the best time to look to buy options is a couple weeks, probably 6 weeks or more before earnings, when the implied volatility starts to increase and options become more expensive, so that you can benefit from an increase in volatility and avoid buying right before an earnings announcement, for example, when you're paying a big fat premium. And then we have really strong position sizing rules, Greg. And I know you've been trading long enough to have made this mistake. And I know you're also a human being. So the odds of you making this kind of mistake, and I know I've made this kind of mistake before. Have you ever gone out and loaded up on call options? Like, I'm just going to throw that word out there, loaded up, like bought a bunch, more than you should have.
Yep.
Because they were cheap.
Yeah. So, before you had talked right when you started about, not really, being a little intimidated by the options, the size of the option world and all that kind of stuff. Well, that's the thing. When you go in and you look at an option chain, there are so many strike prices. There's so many dollar amounts for these different strike prices. It's like you're like a kid in a candy store if you really don't know what you're doing. And there's nothing worse than trying to go way out of the money, for a call option and trying to hit a lottery ticket and then loading up on something like that. The one thing I think that people miss, and we talk about in the playbook there is, you know, you can leverage up using a long call option, but the problem is time decay can eat away the whole amount if you don't have some kind of exit strategy to do it. So yeah, I've done it. I honestly don't know anybody that hasn't done it. I can honestly say that it was early in my trading career, so I think that's probably a good thing. But yeah, you get so excited sometimes. You see a setup that you like, and Frank Martin being the breakout king there. That's usually what I see is some really tasty breakout, really bullish setup, and then you just want to go for the gusto. You kind of think, that's it. I'm playing poker. I'm putting all my chips in and see what happens. Well,
Oh, yeah.
usually it doesn't turn out well. So
Well, and the biggest problem with that, Greg, is every once in a while it'll actually pay off. Every once in a while you'll actually hit pay dirt.
yeah.
And the stock price does rise a lot, and that occasionally works for people. But more often than not, statistically speaking, it's not going to work for people because the odds of probability are against them over time. That's why options expire. That's one of the biggest challenges with them, is they do expire. See, one of the benefits of buying stock versus options. Yeah, stock costs more. The most leverage you can get on stock is in a margin account. Typically it's 2-to-1. So you put 50% of the money in, you can control 100% of the stock in a margin account. They charge you a little bit of interest for doing that, but you can get 2-to-1 leverage. Now, an option can give you, between, I'd say, 10 to even up to like 20% leverage, depending on how the options are priced, where you can control a lot of stock with a very nominal amount of money. And I'd say on average, it's about 10-to-1 leverage in that ballpark. And so, you can really create a lot of leverage. And I think there's a greed factor and a temptation in there for people to want to, get rich quick and to take that leverage and to really, load up on it in hopes of getting rich quick. And so I want to caution people against that. Understand, yeah, it can be done, but in your best interest as a trader / investor, to make it long term in this game, you got to have rules, and that's designed to protect you. So a long call, this is what the risk graph looks like. And a risk graph, this is the basic anatomy for the risk graph. And we're going to go look at a real risk graph here in a second. And what you're looking at here is, on the way that these risk graphs work, is they put your potential profits and losses on the graph over here on the y-axis. And then they've put the stock price down here on the x-axis. And if in this example, we were talking about buying the stock at $100 or whatever price we're talking about. So if we had a $100 strike price, and let me actually grab my marker so that's easier to draw, $100 strike price, and the stock price rises and goes up to 105. Or it continues to rise and goes up to 110. Or if the stock price were to fall and drop down to $95, or drop down further down to $90. So that's where the x-axis is the stock price, and then the y-axis is your profits and losses on the option. And so if we had a $100 strike price and it cost us $5 to buy that contract, then our break-even point would be the $100 strike price plus the $5 per share. So that'd be $500, for one contract of 100 shares. And your break-even point would be out there at 105. And if the stock price ended up, being above 105, it was out at 110 at expiration, you would, have spent the $5 to get in. You have the right to it at 100. So you would end up owning the stock at 100. You could sell it out at 110. And if you did that, it would show your profit at expiration at $500. because you'd be able to exercise your stock, own it at 100, turn around, sell it out here at 110 at that price point. You'd, pocket $1,000, but you spent $500 to get in the first place. So your maximum, your gain there would be $500 at that price. If it went up to 115 or higher, you'd get a different price. So the general idea of the risk graph, it shows you where your potential for profits are, shows you where your losses are. And one of the neat functions and features of that is if you spent $500 to buy the call option, the most risk you would have is $500. Like, you couldn't lose more than you spent on the contract. You wouldn't have any more exposure to risk, because when you buy the contract, you have a right, but you don't have any obligations. And the seller has the obligation. They get to keep your $500. So the seller's risk graph would literally be the mirror opposite. Their risk graph would look the exact opposite. They'd have the same strike price, they'd have the same break-even point. But to the seller, that's plus $500 in their pocket, and to the buyer, it's minus $500, in this example, out of their pocket. And if the person who sold it to you owns the stock, well, they're covered. They have their risk covered, so they don't have to worry about that part of it. If they were selling you the call option without owning the stock, that's what they call naked option selling, and that's something that we discourage from the call side. We don't like selling naked calls on average. But that's how the risk graph works. And so as we go look at a live example here, let me switch over to the risk graph we were just looking at. So in this example, this contract that I selected from the option chain is good till the 15th of January, 2021. It's for the $100 strike price. That's the $100 strike price. And the premium right now would cost $6.55. So you'll notice where the risk graph is. Here's the $100 stock price. And if it rose up to 105 or rose out to 110, you'd make some, really nice money. If it went down to 95 or even down to 90, you really couldn't lose more than you spent on that premium, $6.55. And that's each contract's for 100 shares. And so if you look at the maximum risk on this, that risk graph, if you look at this little window right here in the left corner, wherever I point to on the graph, that blue line shows me my maximum risk, maximum reward. And the maximum risk there is $655. So you couldn't lose more than $655. The strike price, again, 100 plus the cost of the premium, $655, puts the break-even point out here at 106.55. So if I put my cursor right at the break-even point, which is that little red hash mark at the $0 point, $0 profit or loss, that's at $106.55. Now, again, if the stock price rose out to 110 and you waited till expiration, that's what the blue line represents, is you would make, if it rose right out to 110, you'd make $344.80 between the price you paid, and it shows you kind of that maximum gain. Now you'll notice up there it says $641. That would be what the value of the option would change if that were to happen like right away, if like the stock price ran up there today. But over time, the option contract, the purple line represents the estimated values based off of today's time till expiration and the current measure of volatility. And on these risk graphs, I really love risk graphs, Greg. I could spend all day talking about them. I think they're a ton of fun. The purple line, again, is going to represent the theoretical value. Like if the stock price were to run up to 105 today, you could sell that option for about $3 more than you bought it for. You'd be able to sell it for about $9.55. And that would make you about $300. But that would only be if that happened today. If it took a week and we went from today's date and I moved it out to say, the end of next week on the 25th, if it took a little over a week to run up to 105, you'd still make money, but instead of making $300, you'd only make about $270, $280. And that would be because of the time decay and that value of the option that's based on time. And, these are some of the things that when I was brand new to options and I would kind of look at the options chain, it was hard for me to understand that, oh, hey, a January option costs more than an October option simply because there's more time between now and January. See, if I bought an October option, I could control the stock at $100 for between 320 and 285, so about $3. To control that same stock at the same $100 strike price from now till January, that's a lot more days. That's 121 days till expiration. That same contract would cost you, again, $655 is what we're figuring out. So great example here, Greg, on that particular stock. Nice bullish uptrend. I'm not overly familiar with Agilent, but tech sector's been running strong. Today got a little bit of a red candle, but overall nice uptrend. And if I wanted to use some leverage on this, that's an interesting concept. One of the other great lessons I learned from one of my mentors, which I thought was one of the simplest concepts done. It was kind of a sophisticated or a advanced way of explaining a simple concept. And when it comes to like rates of return in investing, there's, two ways to think about a profit or a gain. And if you really think about the way investing goes, if you want to get a nice rate of return, you either need to find assets that go up in value more, or B, figure out how to put less money into the investment to begin with. And so if I could put you on a scale of the amount of capital needed to place a trade, and ideally speaking, wouldn't we all love to be able to get into an investment for $0, like, no money required, no down payment required, nothing? That'd be ideal. It's not very realistic though, is it?
Not really.
Okay. And I think everybody understands that as you go, on that scale, you can get out to where you need to have 100% of the capital required. So if I wanted to go buy Agilent stock right now, and I wanted to control the right to that, and again, let's just call it $100 to make the math easy. If I were to buy it today at $100 per share, and I wanted to buy 100 shares, well, we can do the math. Want to have all the capital required to buy that in a cash account, 100 shares times $100, that's going to cost you $10,000. Okay. And I'm not that great at math. You want to double check that for me, Greg? I think I got that right.
Carry the 1, add the 0. Yep. You're good, buddy.
Okay. So $10,000. Well, that would be 100%. Now, if you were to look at that stock price, and again, let's say the stock price rose up to 110, that would be a 10-point gain in the stock price, and your $1,000, it's not times 100 shares would be, or $110, it'd be times 110. And it would turn, your $10,000 would turn into $11,000. So pardon me for stumbling over my words, but if it rose 10 points, you'd make $1,000. And that'd be a really nice return on investment. Again, 10% return, you'd be feeling great about that. And until you found out you could have bought that stock on margin, which kind of changes the game. And so, well, what's margin? Well, what a margin account is it's where it only takes 50%. So just by getting a margin account, you can bring the cost base of that trade down from $10,000 if you have margin. And you can bring that cost down. We don't have to put in 50%. So they require you to put in 50%. And that would bring the cost down to $5,000 initially instead of 10. And if the stock price rose 10 points up to 110, you'd still have the $1,000 in profit, but you only put in $5,000. So what's your ROI? The stock did the exact same thing. It went up 10 points, but what just happened for your ROI? It went from 10% to what?
20%.
I know. Yeah. 20%. Right. So this was one of the big kind of aha moments for me when I saw this is, well, look, when you're measuring ROI, you're taking the value final of the investment and you're subtracting it from your value initial, whatever it cost you. So, if the stock price rose to $110 a share, the value final would be 110. And if the initial purchase price was 100, the initial value was 100. And so, the final value 110 minus the initial value 100, that would equal $10, $10. Well, you could either find stocks that went up more, find a stock that can go up to 120 or a stock that can go up to 130 or 140 or 150 to make more money. Or you can figure out how to put less money in. To figure out your ROI, you have to divide your value, your gain, by your initial investment. So the value initial. So to figure out the equation, that equals your ROI. It's the final value of the investment, subtract the initial value from that, and then divide it by the initial value you put in, and that's where you get your ROI. Well, to change the outcome, again, to get to where if we use 50%, the ROI is going to increase, not because the stock price went up more. The stock price still went up $10. It still went up to 110. But if you only put $5,000 in, the same $1,000 return right there is no longer 10% because you're putting in half the money. It's 20%. Now, one of the beauties of options is, margin will get you down to where you only have to put in half the money. Options will get you down to where you only have to put in somewhere, I'd say, between 5 to 10%. So 5 to 10% of the capital requirement. And this is one of the reasons they're so attractive. And when you look at that, even that example of Agilent, and Agilent's got some good things about it. I think from the chart, there's the options are not, they're probably not, and I know that's probably not why you picked the stock, Greg, but the options are a little illiquid when I look at them. So they have some wider bid-ask spreads, which if I'm playing those, that's fine. It's just, I need to make sure you understand that. So, but in this example, controlling the stock till January for 121 days at $100, we're really only rounding up 8 cents to get there. It's going to cost you $6.55. Well, that's about 6.5% of the capital requirement. And then if you put in the full $10,000 to buy it, does that make sense? I mean, to control that stock at 100 from now through January only cost you $655. So, literally we just brought down the cost base of the investment from, 100% going to margin, got you down to 50%, going down to the options, you're down at 6% of the initial money put in. So you can really, really benefit from the, getting a big ROI. But the trade-off is you could potentially lose all that money. You could lose the entire investment on the option. The option can expire worthless. But that's a perfect example of how cheap options can get and how much leverage you can get. I mean, that's literally not quite 10-to-1 leverage in this case, but that is pretty darn close to 10-to-1 leverage. It's actually a little more than that. It's 10-to-1 leverage would be $1,000. So we're better than
21.
Yeah. Not quite that, but it's pretty darn good. So you got a ton of leverage on that. And this option does expire. And again, the stock price is only trading at $100, 99 and change. It's only trading at $100. So paying $6.55, again, that's why you don't break even until it gets out to 106.55. That's all extrinsic value on the option based off of the time until expiration and the expectation of volatility. But this is something that I've always found super cool. There's an efficiency to that option pricing. And this is kind of fun. I'm just going to show you this, Greg, and this, hopefully it works out the way I think it would. I could buy the stock at $100 a share and purchase an option to control my risk. And I could purchase a put option to control my risk from now until January. And that put option is going to cost me, about $675 or so. And my risk profile would look about the same. So I'd buy the stock at $100 a share. So I'd have all the upside potential of the stock and I would have all the downside potential of the stock. And my risk reward is basically, my cost base of $100 per share, times however many points it goes up or down. So if it moves up to 105, I make $500. If it drops down to 95, I lose $500. If it drops down to 90, you could lose $1,000. If it drops down to 80, you could lose $2,000. Like you could actually, really as an investor, you could find yourself underwater. And so one of the first strategies I learned with options, Greg, was how to buy a protective put. So if I bought the stock and I bought the $100 protective put, that would give me full coverage. It would cost $675. It would give you the right to sell the stock at 100, which is the price you paid for it. And your maximum risk would be $675. That's the risk of buying the long stock and the protective put option. And there's a really fun efficiency with the market. And this one's not spot on. There's about 20 cents difference between the two. But buying the call option without owning the stock gives you the exact same risk profile as buying the stock and then buying insurance on the stock with the put. So
saves you $20
and it saves you
an
20
extra
bucks.
commission.
And not only that, instead of putting in, the full $10,000 and then buying the insurance too, you're only into this thing, $655. And so the amount of capital you're using to control that stock, I think is really impressive. Yeah. Married put. Exactly, Dennis. That's what you call it, a protective put or a married put. So there's a really cool efficiency if you were to actually price out a married put versus the call option. The risk's the same. The delta's about the same. Like, check this out. Okay. Look at this, and if the stock price were to go up 10% or down 10%. So that's what these little price slices are showing, is if the stock went up 10% or down 10%, this is what the profits and losses would be. And this is what your exposure would be. You'd be with your call option and the put option, your net delta would be 52. Your gamma would be 2.4. You'd be losing about 289 in time decay per day. You'd have about 22 exposure and volatility. That's for the stock and the married put. Compare that to just the long call. Your delta is 52. Your gamma is 2.4. Your theta is negative 2.75. So it's a touch less. And your vega is about 22. So, I mean, the biggest difference is the stock and the married put, which is a great strategy for the long-term investor. You're going to lay out $10,000 in capital plus another $675 for the insurance. And that protects you if it goes down, but the insurance time decays there at 289. It reduces your delta because you bought a bearish position to protect your bullish position. So you're not as bullish, and you won't lose more than you spent on the put. And the stock price can go up infinitely. So you have unlimited upside potential when you buy that married put. But I think it's really cool to actually compare and contrast the delta, the gamma, the theta, and the vega of the married put versus just the long call. They're so similar on an efficient stock with lots of options that are very liquid. It gets so efficient on that it's really cool to think to yourself, you know what, I could just buy the call option. And, I won't get any dividends that the stock pays, and I won't get 100% of the return on the stock, but my percent ROI goes through the roof. So that's kind of a fun way of looking at that. So come back to the old playbook here. And again, it's got your risk graph, kind of spells out what you're looking for here. And it talks a little bit about how you manage it. What do you do if it goes up? What do you do if it goes down? You can use stop losses on call options. You can buy the call option and say, well, I'll sell it if it goes below this price, and you can control your risk that way. When it goes up, it's really exciting when you're winning on a call option. But there's, little things you can do to make sure you're locking in your gain. Hey, when you get, 50% of the gain, or if the stock price has popped up and hit your profit target, it'd be a good idea to, sell or change the trade. You can hold it indefinitely, but I bet you've done this too, Greg, where you've let a winning trade turn into a losing trade.
I have.
Especially like on a call option where you're like, yeah, I'm winning. And I got 2 months till expiration. It could go up even more. And you're like, the greed gets you. And then 2 months later, the stock price has gone back down. You held on to the call option. The call option expires worthless. And you're like, dope. Yeah. Could have sold that contract for more.
And that's why we're rule-based traders, and we don't let that happen. So I've got some old special rules for call options, and I never let them expire worthless anymore. I did that when I was brand new, and it didn't turn out so well. So I had to get cracked over the head a couple of times, but I did learn the lesson. So
well, eventually, you teach me anything 10 or 20 times, I'll learn it. Maybe some lessons are harder to learn than others. Indeed. But, this is the kind of thing where, if my risk tolerance was within that $655 threshold, like if I could afford to risk at, 655 bucks. I could buy that call option without a stop loss, not really think twice about it. And if it goes up, awesome, I win, I can make some money and sell the option. Or, if I held it through expiration, I can't lose more than I spent. And in this case, I'd probably say, I would say if Agilent broke below $95, I was probably wrong about it going up.
Yep.
Because that's a big support zone. And I'd say I was definitely wrong. And I might not wait that long, personally, like if it broke the 50-period moving average, I might be out. But if it broke that support zone, I would for sure know that I was wrong. And so by the time it broke 95, you'd be down 250 bucks or so. And you could offload the option for $4, ballpark. And, you spent $6 on it. And theoretically, if the stock price went down towards 95, the contract's going to be worth less. It's going to be worth, less than you paid for it. And in this case, the little purple line helps me estimate, if that were to happen, that's by the 25th, a week and a half from now. If it dropped down to 95, I'd lose about 250 bucks, which means if I spent 655 on it, I'd be selling it for about $4.05, somewhere in that ballpark. And I could be out. Somebody else buys the contract from me. The market maker takes it off my hands. I don't have to worry about it. I just get the going rate. And so I can limit my loss, and I don't have to accept the maximum loss of the option. No. But this is where the temptation is for people. It's like, oh, I had $10,000 to invest in the first place. That means I could buy 8 calls or 9 calls. And, in this case, I'd not, if I did 10 calls, I've got 60,550 bucks in it. And if it pops up to 110, woohoo, you double your money, you make $6,000. But if it ran against you, you could lose the entire value of the investment if the stock price expired at $99.92.
I think a good point too, Noah, is even if you use that stop area where you're going to get out, that $250 loss becomes $2,500 with 10 contracts. And I think that's a part that people miss. It is the greed that gets them. But, even if you get out when you say you're going to get out and you're doing 10 contracts, that's $2,500 bucks. Now, if your pain threshold was 250 and you exceed it by 10 times, it's going to cause you some emotional pain, and it's probably going to mess with your head a little bit too. So,
for sure,
this is where the power of leverage can get you big time. So,
it's a lot of leverage to wield.
Yeah, I hate to be the bearer of bad news, but I have to say goodbye to the YouTube and there, Noah. I will catch you guys on the next one.
Well, hey, that reminds me, we're all up against the clock, so I appreciate you coming out, Greg. And, I've enjoyed this conversation about the call options, and we've, had a good little showing out here. So I'm glad everybody showed up. But, options are powerful. Options, if you'll pardon the pun, give you choices, and it gives you choices in how to approach it. So what I'm going to do is I'm going to do one more quick example. We'll pick a stock that, if any of you are interested in out there, we could probably do one of those. If Breakout Frank had one. I've had my eye on Visa and MasterCard lately. I like the technical setup here for MasterCard. And I'll explain to you why I like the technical setup on the stock. Then I'll talk to you about how I kind of go about looking at the options. So MasterCard's got this big upward trend. It's been running up since the big correction from the coronavirus correction. Got towards the tail end of March, and then come April, it started putting in higher highs and higher lows. And it's been trending up for several months now. And that's in the overall context of a big, long-term uptrend. Like, this stock's just been going up and up and up and up. And the old saying on Wall Street is that the trend is your friend. Well, it's got this pullback correction down here into the 325 neighborhood, where MasterCard just put in a double bottom, a bottom here, a bottom there. It tested that 325 price once. It tested that 325 price twice. It's come back up to that 345 threshold. And it looks to me like it's got the potential to break out. And that creates a little W pattern. And whenever I see W patterns on charts, it's an indication of a double bottom. And the W pattern, like you see here, or again, this is a tight W pattern. You see it here. And you'll see this W pattern lots of places. When it breaks that resistance, it's a good time to buy. It doesn't guarantee that it's going to rise, but if you bought when it breaks the W, if you were a buyer in here, you might benefit from the continuation of the trend. So guaranteed, not a guarantee, void where prohibited, not valid in all states. I think MasterCard's got a decent little uptrend, a good little signal pattern, a reasonable trade setup. And whether or not I decide to trade this with real money, I don't know yet. I'm kind of waiting to see what happens with the market tomorrow. I need some upward confirmation. But instead of putting in $341.85 a share, which again, you could go buy 100 shares and, pick it up at, let's just call it 342 to make the math easy. So if you bought it at 342, you're in that, $32,400 in a $34,200 in a cash account, $17,000 in a margin account. And we can probably go control the options between now and January, right at 340 for about, that's got a bit of a bid-ask spread to it, but we could pick that up for, $26. Now, if I followed my rules very carefully, like we do in the playbook, I would be buying in the money. I'd be buying either the 335 or the 330 strike price. So that puts me out more than 2 months, and I'm buying a delta close to 60, which in this case, the delta right at 60 is the 330 strike. So I'd be picking that up, and I'd be into that $3,180, which is a significant amount of risk. And I could say, okay, I'm willing to buy that. And I'm willing to bet that, hey, if it goes up and continues to rise, I can hold on to that through January. But if it breaks this 326 support zone where that double bottom, that my entire premise of it being bullish, if the stock price came down instead, I don't want to find out how far it can go down. My bet was that it was going to go up. And so I could control and limit my risk. And, if it runs up, awesome, I'll be happy. If it goes down, I can stop the bleeding and get out without an adverse I'd be kind of negative on no big deal on my emotions, not that big of a deal, so that I can avoid the pain scale that comes in, down here when you're like in time. And that looks more like a really bad jack-o'-lantern. I got to learn how to draw pain better than that. Let's try that one more time. Like, oh no, that hurts. Oh, that's better. You'd be feeling really sad if the stock price went down and you lost the whole value of that option. So in this case, it's $3,180. If it broke below support at 325, I can estimate my pain would be about $1,000. I would have to be comfortable with that before I pulled the trigger on that. But that means I'd be buying the option for 3,180, and then I'd probably end up selling it at 2,180 if it went down that far. And I'd have to be okay with that in order to trade with that call option. So I could say, okay, I will buy this if it goes up, but I can also create an opposite order, the first trigger sequential, create an opposite order. And I could put in a stop loss and say, you know what? Dump this if it gets below, $2,100. And that would give me a maximum risk of $1,180. And I'd make that, good till canceled. And if I sent that order in, it won't buy until the market's open tomorrow, but it would buy the call option. I'd have unlimited upside potential. And if it broke support, it'd stop me out, and I'd take my lumps. I'd cry a little bit, but I wouldn't lose $3,300 or $3,100. I'd keep my losses at 1,000. Now, that's a lot of leverage to wield. And for some traders, that would probably make you uncomfortable to risk $1,000. So you might find different ways to trade that. And we'll do webinars on that as well. And of course, we're always talking about that stuff. If I wanted to take that same trade and reduce my cost even more, I'd probably do a bull called debit spread, which is a whole nother topic for a whole nother day. And I would love to talk about that with you as well. So we'll come back and we'll do a special webinar on debit spreads and show you how you can bring the cost of trading down even further so that you don't have to lay out as much hard-earned capital to be a participant in the markets. Have you guys had fun tonight? Have we taught you something of value, or have you seen something that interested you? And again, I know we got a lot of our pro members here and we got a handful of newbies. So if you're new to us and you want to, get to know us better, come and hang out with us at Tackle Trading, and you can go, straight to our homepage. We offer a 15-day free trial to check out our community. You can scroll right down to the homepage and take a risk-free trial, get to know us, come hang out with us more, and take that education to the next level so you can be a more intelligent investor. You can be a more intelligent trader. You can be a disciplined trader investor that learns how to control that risk and take advantage of the awesome opportunities you see out there. So appreciate y'all coming out, and I will see you guys all on the flip side. We can see you guys. We got awesome shows for you tomorrow and a couple more tonight. We'll see you.